Hello, and welcome to our MDM webcast, the Annual Distribution Outlook. I'm Tom Gale, CEO and publisher of Modern Distribution Management and our website, mdm.com. MDM reaches more than 20,000 wholesale distribution executives daily with our guidance and analysis on distribution trends and operational best practices. Thank you for participating in our call today. I'll serve as your moderator for today's 60-minute program sponsored by Oracle NetSuite. Before we get to our discussion, I have a few operational tips. We'll be, actually in a few minutes, we'll be sharing a link in the chat section of the Zoom window here for today's presentation. The program today is being recorded and we'll be sending you a follow-up link to listen again or to share with your colleagues, as well as a link to the presentation slides. In the interest of time, we won't be taking questions by phone, but we have a Q&A portion at the end of our time, time permitting. So with that, I would like to first introduce Ranga Bodla with NetSuite. And Ranga, welcome. Thank you for hosting our program today.
Thank you so much, Tom. It's always a pleasure. And if you'll go ahead and go to the next slide, I'll do a quick intro of this. So I've been in NetSuite for 10 years, and this actually is our 10th year of sponsoring this annual distribution outlook. So I really appreciate the partnership that NetSuite has had with MDM and Modern Distribution Management. And the reason we do that is obviously to continue to reach the same wholesale distribution leaders that you all are talking to are many of our NetSuite customers as well. If you go to the next slide, just to give you a quick intro, if you're not familiar with NetSuite, we are the leading provider of cloud-based ERP and financial solutions to manufacturers, to distributors, to retailers, as well as a number of different industries. We service over 24,000 customers worldwide. And in the last 12 months alone, we've had 4,500 new customers that have signed up with NetSuite. In 2016, Oracle acquired NetSuite. We run as a global business unit of Oracle, however, do run independently and provide our solutions in the market. And we've actually been around for 23 years. We were founded in 1998 and continue to grow and service our customers. Now, if you go to the next slide, just a couple of things that, in terms of technology, one of the things about NetSuite that's been so unique and is part of our value proposition and part of our differentiator is we're not just focused on financials. We're focused on the whole ERP stack with an integrated both ERP, CRM, as well as e-commerce solution. And as many of you expressed in the industry outlook, some of your challenges around technology and around CRM as investment areas, as well as e-commerce, those are all parts of the NetSuite solution. Many of our customers leverage us both for ERP, for CRM, as well as for e-commerce. And if you go to the last slide, this just gives you that view. We are a single unified solution around one data source across for ERP, for CRM, for e-commerce, but also for services and for HR and HCM. And with our platform, many of our customers, as I mentioned, manufacturers, distributors, retailers have found value with the NetSuite solution. And many of our customers are also MDM customers as well. We really appreciate the partnership. We appreciate being part of the conversation and looking forward to speaking to you during the rest of this conversation. With that, I'm going to go ahead and turn it over to Dave to go ahead and go into really the outlook itself. Dave?
Well, and actually, Ranga, let me just take it back for a second here because I'd like to introduce just briefly. And it's also, we've had a partnership that goes back, I think, 11 years now in terms of the quarterly survey work that we've been in partnership with Ranga and Dave. David Manthey is Baird's longtime senior analyst covering industrial distribution and services. And prior to that, he was with Strong Cornelius in capital management. Our agenda today, I just wanted to touch on it briefly and really just make the comment that as we took a look at this today, it's virtually the same as when we were together 12 months ago. World is not, and I can't think of a time in the last 10 years, honestly, when our outlook here at the beginning of the year that takes in the type of industry surveys, the pulse of what's happening across industrial electrical sectors in particular in end markets, but also some of taking a look at some of the key shifts that have been taking place. And we'll do that again today, but I've been looking forward to this conversation really since we hit the new year, because it's a very optimistic year shaping up in a number of ways. There's a ton of challenges left, but it's going to be a very different and very different, interesting conversation today. So with that, Dave, let me hand it off to you, and thanks so much for joining us today.
All right, thank you, Tom, and as always, thanks to MDM for providing the opportunity. As Tom said, my name is Dave Manthey. I'm the Senior Industrial and Building Products Distribution Analyst for Baird. On the next slide, the main reason I put this one in here is so you can get a look at Quinn Fredrickson, who is my associate on the team. Quinn has been essentially running the survey since the past couple of years. He's been on the team since 2016. And many of you know Quinn, and you are engaged with him on a quarterly basis, and you understand why I say that I'm so fortunate, and as a firm, we're very fortunate to have Quinn on the team and as an integral part to the distribution franchise. On the next slide is where we left you approximately 1 year ago. This is not for right now. This is from last year. And where we left you was we said that the base case was essentially no U.S. recession, modest growth across these different end markets, with industrial, at the time, if you recall, it was the trade disputes and the tariffs, and industrial was very weak at that time. Commercial construction was somewhere in the middle. Residential was still doing okay. And that was sort of the base case outlook we had for 2020. The bull case was that we'd get a trade deal and some resolution there. Inflecting global PMIs would drive industrials, which would pick up the entire complex. And we put those odds at 30%. The bear case, 20%, was that manufacturing continued to wane and the US consumer faded and we went into some sort of a downturn, if not recession. We put a 0% probability on the actual outcome, which of course was global pandemic, which we'll spend quite a bit of time talking about here. But this is where we left you last year. Hopefully our outlook does not have to include something coming from left field like we experienced in 2020. But let's take a look at the next slide. What I shared with you then, and I like to start with, is the yield curve, because the yield curve has done a really remarkable job of predicting recessions over time. And what I said to you last year was that an inverted yield curve, that's the difference between the 10-year and the 1-year spread on treasuries, when that goes negative, 7 of the past 7 recessions have been predicted by that state of being. Last year at this time, I told you that in May, August, and September of 2019, the yield curve had also inverted. But since then, when I gave the presentation, it had gone back positive. And so I said, well, probably unlikely we go into recession. Well, whether it was just luck or fate, 6 to 9 months after the yield curve inverted, sure enough, February of 2020, we did enter recession. And we definitely experienced that for external reasons, but I just think it's important to point out here that it's now not 7, but 8 recessions have been predicted by an inverting yield curve. On the left-hand side, you see the current state of the yield curve. That's the blue line, which is positively sloped. That should be positive for the economy. The reason I showed Jerome Powell there on the left, he's essentially sitting on the low end of the curve, keeping the short rates unnaturally low, as the Fed funds rate is essentially 0 indefinitely at this point. On the next slide, this is a bit of an eye chart. It's not meant to be granular. The way to read this is green boxes represent expansion in global PMIs, so 50 plus. Gray boxes would represent around 50, and the pink and the reds would represent sub 50, so contraction in the manufacturing economies. And the way to look at this in aggregate, if you just zoom back and take a look at it, 2019, there was a lot of gray and pink in there. I mean, Saudi Arabia somehow and Uganda, they had great years. I don't know why, but everyone else, it was sort of that gray and pink. It was not very good. Even entering 2020 before the pandemic. And then, of course, when we hit February, March, April, and on, everything came to a screeching halt. You can clearly see where that happened. The good news here, and we'll talk more about this, is as we come out of those, the spring and into the early summer downturn, what you see is more greens on the right-hand side. And what that implies for the global industrial complex is improvement. And green box, again, it doesn't necessarily mean things are positive. They could still be below zero, but they're sequentially, month by month, continuing to improve. And that's clearly a positive sign for right now. As it relates to the stock market, on the next slide, last year we mentioned we were in the longest bull market in history. It had lasted about 11 years in duration, which the 1990s bull market was the former champion at 113 months. But when coronavirus started to hit the news in January, February, and then the market really cascaded lower in March in response to the news, eventually falling peak to trough by about 30%. Some of you may remember, I remember exactly where I was at the time, when Bill Ackman came on CNBC and gave his impassioned speech about hell is coming. And that was March 18th of 2020. I think it's interesting that exactly 3 days later, the S&P 500 bottomed. That's where I have it circled on the chart. And interestingly, Sweet William here was reportedly about $2 billion richer at that time because he had been buying stocks hand over fist at that point in time. The takeaways here, I would say, don't believe everything you see and hear on TV or in the media. And second is, as it relates to the stock market in particular, it's typically darkest before the dawn. On the next slide, we talk about two of the factors that we like to address when we're looking at the outlook, things like inflation and the employment outlook. And this year, these are almost cartoonish on the top, the employment ones. I'll touch those in a second. Inflation has remained subdued. And the good news about inflation remaining very mellow is that gives policymakers a lot of latitude to pump the system with liquidity as needed. And I'll talk about that more in a second here. But as it relates to the employment indicators, you can see this magic number. This is on a monthly basis. Typically, if you're adding 145,000 jobs a month in the U.S. economy, that's a signal of a healthy economy. And we had that for the better part of a decade. Things were going well. The unemployment rate came down from double digits all the way below 4%. Once we hit the pandemic, just to put this in perspective, where that red line is at 145,000 jobs per month, if you were to trace the data point that falls off the chart here, if you're looking at this on your computer at your desk, that data point would reside somewhere around your knees or your shins down below the surface of your desk. That's how far we dropped. 7 million negative at the trough. And of course, that had the effect of pushing the unemployment rate up to nearly 15% before we've seen the recovery that we have. So we're fighting our way back. And I think recovery is one of the key themes we'll talk about here as we move through the rest of the slides as well. The next slide as well. These are indicators that we look at to gauge the health of the stock market. As the stock market, we think, discounts conditions 6 to 9 months into the future. And therefore, it does have implications for what 2021 is going to look like. This is a model which we showed you again last year, Dr. Van K. Tharp. It's a very simple 3-factor model to gauge the health of the stock market. And there's 3 factors. One, is the market cheap? Is the S&P 500 price to earnings ratio 17 or less? 2, is it going up? Is the price of the S&P 500 above its 250-day moving average? And 3, is the Fed out of the way, meaning there have been no rate hikes in the past 6 months. Well, as you look at these 3 factors in the market today, the S&P 500 clearly is not cheap. It's well above 17. It's into the low 20s on a PE basis, but it is going up. and the Fed is out of the way. So as it relates to the stock market and the health of the future of the stock market here in the near term, seems to be fairly positive. On the next chart, we drill down a little bit more as we're talking about distribution, and distribution is my life too, in terms of distribution stocks. When you look at the valuations of distribution stocks relative to the S&P 500, they're cheaper, and they've been getting cheaper for the better part of a decade. So if you look at the chart on the left here is relative valuation versus the S&P 500. Way back 10 years ago, the stocks as a group traded at a 50% premium to the valuation of the S&P 500. Today, they're trading at a slight discount to the overall market. So I think that's a good indicator. That's a good sign for distribution stocks specifically. And second, the two charts I have on the right here, these are indices of building products distributors and industrial supply distributors. And as you can see, both of those indexes well above their 200-day moving averages. So they are too going up. And in fact, 100% of the stocks that make up those indexes are also above their 200-day moving average. So a very good breadth as it relates to the strength that we're seeing in the market here as it relates to distribution stocks specifically. On the next slide, just to close the loop here, as it relates to distribution stocks and the health of distribution as we move into 2021, these public companies, these stocks have historically outperformed for several years coming out of recession. The way to read this chart is that gray bar on the far left, that's the recessionary period. These lines that you see are coming out of the specific recessions that are listed here. And I think the theme that you see is that these stocks tend to outperform the market for several years coming out of recession. And it's happened for four particular downturns in a row. And we think it's the case again this time. Said another way, on the right-hand side here, this is just a different depiction. This is outperformance of the aggregate distribution group following a sub 45 ISM, which we had in April and May of 2020. So again, we expect an upward bias to the distribution group, in addition to the fact that we think the market is fairly healthy right now and in a pretty good place, that having implications for the economy over 2021. On the next slide, we talk a little bit here about the Fed funds rate. And I know I've touched on this a number of times, but with inflation in check and the economy suffering through these pandemic-related shocks, policymakers have flooded the system with liquidity. And the Fed funds rate is essentially hammered down on zero right now and probably not going to change anytime soon. In addition, the Fed is buying treasuries, they're buying corporate debt, they're buying mortgage debt in an effort to maintain a liquid market and some would say artificially depress rates across the curve. And what you see here on the right, that's when people talk about helicopter money, that's Jay Powell and his predecessors dropping dollars from a helicopter to continue to fuel the economy in a time of crisis or a time of need. The final point I'll make on this on the next chart, not only has the Fed been extremely accommodative, but US fiscal policy has opened up the taps as well in an effort to sort of stave off the effects of the pandemic and some of the shutdowns and the job losses that we saw before. And the offshoot of that is not only has the national debt risen, and that's how we know that there's money flooding the system. 10 years ago, the national debt was under $15 trillion. Today, if you look at the national debt clock, it's about $27.8 trillion. So it's massively inflated over time. And again, that's an offshoot of this liquidity being funneled into the system. The two charts at the bottom, the reason I put those in there was to show you that when you have this much liquidity, when money is this plentiful and inexpensive, it finds its ways sometimes into the more speculative parts of the market. And what we show here is on the left is Bitcoin. You may have heard of it. And on the right-hand side is an electric car company you also may have heard of. But the net of all this is, I think when we look at the economy and what's going on, I think we're in pretty good hands right now. The Fed, fiscal stimulus are in concert right now to flood the system with liquidity in order to keep things going so that we don't have a secondary fall off. As it relates to where that money finds its way and bringing it back to distribution on the next chart, money being so plentiful and so cheap, that helps private equity firms. Private equity firms tend to lever up to buy quality assets, public or private, and run them in their portfolios. And you can see that they've been aggressive here. American Securities, on my list in particular, within industrial and building products distribution, American Securities bought Foundation Building Materials. They also bought the interiors business from Beacon Roofing Supply. Bain Capital bought USLBM to keep with that building products theme. And then Builders First Source and BMC had a merger of equals and became the leading company in that industry as well as Home Depot, which bought HD Supply here most recently. But I think if you look at that chart, things really started to happen late in 2020. When I had this conversation with you last year, the last deal we were looking at was the Wesco Annixter deal, and pretty much the FBM deal just happened in the fourth quarter of 2020. So we had a flurry of activity, and I think again that's representative of a very liquid market and obviously good for valuations of distribution companies. The final chart before we go into the subsectors is a quote that we've been using here to support the distribution group and the stocks in general. As the stock market has been really enamored, and the world in general, with disruptive technology, the point here being that disruptive technology is great, but parts still need to move from point A to point B to make a Tesla, and materials need to move from somewhere to a job site in order to build a house or to renovate your home to make a backyard oasis or what have you. So the point here being that distributors will always be a critical link in supply chains. This reminds me of it was about 20 years ago. I remember sitting with Roy Haley, who at the time was the CEO of Wesco. I don't think he made the phrase up, but we hear it a lot in our business. We all do. It's the right product, right place, right time, right price. And I think that the application of technology, it's important to remember, and I think Tom and Ranga will talk more about this, but the application of technology, I think it can aid in search and logistics and some of the financial aspects of the business, but they're not a replacement for distribution. So we like to think that within distribution channels, everything in our industry has changed, but everything also remains the same. And the outlook, I think, for those companies that are willing to embrace change is extremely bright as we look into 2021 and beyond. So getting more into the specific sub-verticals I'll talk about here. First is industrial manufacturing. So to recap where we've been and where we're going, the US ISM PMI was clearly weak in 2019. And many people think that we went into an industrial recession in 2016, and you could see where the ISM was at that time. 2019 was as bad or even potentially worse than that. So we were on the brink when we last spoke 1 year ago. Of course, with COVID, we dropped down below 45, and we've come rocketing out of it. Again, as a diffusion index, today the ISM is north of 60. That means we're seeing month-to-month improvement. It doesn't necessarily mean that number is positive, as you can see from the manufacturing industrial production numbers, which, although much better than they were at the trough, are still negative. Capacity utilization coming back and distributor average daily sales growth for the Fastenal, Grainger, and MSC Industrial. I think you can take that mini spike out in 2020. All three of these companies had a big spike due to safety products. Without that, we would have continued to drift down, and now we would be on an upward slope, as we're seeing at all three of those companies if you exclude safety products. So the outlook is bright for manufacturing. I think it's not good right now. It's clearly coming out of a deep hole, but it's definitely getting better as we move into 2021. On the next slide, we look at non-residential construction, which I think is another market that many of you care about. And what we see here is a little bit less optimistic. The Architectural Billings Index, again, a diffusion index, has not broken 50 yet, which means that ever since the pandemic started, things have been getting progressively worse. Doesn't mean they're accelerating to the downside. It just means they are still negative month after month after month. They're going down. Private non-res construction, you can see that continues to fall off. Dodge contracts going down. Commercial real estate loan demand, that's a diffusion index. Hard to know how that ties in necessarily, but I would say based on this data and some that we'll share with you in a little bit here from the survey, not a great outlook for non-residential construction. I think what we've seen, and we've heard this from a number of participants in the survey, is that of course we had the shutdowns in the summer of 2020 where the job sites were just closed. They reopened, but slowly. There were restrictions and distancing and so forth. So it reopened and started to improve. Getting near the end of the year, some of those jobs are starting to wrap up now. But because we've been through this pandemic and because of what's going on in the economy, we just haven't seen that pipeline refill in the non-residential arena. And therefore, I think there's potentially, as we get into especially the second and the third quarters of 2021, it could get worse before it gets better. So our outlook for non-residential construction really not very favorable in the coming year. Residential, on the other hand, from the next slide, extremely positive. So here, one of the things that happened, most of these indices took a big dip down when the pandemic started. Everyone just sort of shut down and didn't do anything. But one of the first things that people did was invested in their homes. So you saw people fixing their homes, building a backyard oasis, putting in a pool, repairing a roof, maybe your air conditioner that worked okay. And when you were at work all day and you come home at night and it was 7 o'clock, it worked okay in that environment. Doesn't work so okay when you're home at noon, like here in Florida or in Texas. So I think a lot of those things started happening. And so clearly what we see here, existing home sales, single family housing starts, the National Association of Home Builders, all of that data right now, in addition to the repair and remodeling data, forward looking, extremely positive. I think 2021 is going to continue to be a fantastic year because of the fact that we're seeing people, so some of these trends, people moving from the north to the south, people moving from cities into the suburbs and so forth. A lot of those trends that existed before the pandemic continue to exist today, and some of them even stronger. So in conclusion, to wrap up here on the economic data before I just touch on some of the survey information, is that we think that the overall economic condition is getting better. So I think recovery is the key theme here. Stock market indicators are fairly positive, and for the most part, because of the fact that monetary policy is extremely accommodative right now. One of the biggest risks is that the Fed starts talking even about raising interest rates. I think that will have a negative effect on the market and potentially the economy. I don't think that's for a while yet, though. And then the other wild cards here, in addition to that, would be how the reopening goes, global trade issues, and then any political issues with the transfer of power here to the new administration. But when we look at these three markets, as I mentioned, industrial manufacturing rebounding, slower in some of the heavier sectors, but we're still getting there. Non-res construction, most of those indicators very weak. If we're looking for recovery, it's probably going to be in 2022, would be my guess. And then residential construction, very favorable single family housing outlook, and the repair and remodel backdrop also remains positive. I've got some more information from the survey we'll share with you in a second. So in general, continued recovery and a housing boom to continue to drive things on that side. So with the next slide, we'll touch on a few data points from the survey before wrapping up here. And first of all, just for those of you that participate in the survey, I want to thank you. Honestly, it's a 5-minute investment. For those of you that do it, it's very quick, but we turn back to you this wealth of information, some of the data we're sharing with you and more, which we hope is very valuable. And so I hope that when you see the link come across from MDM, you'll consider clicking on it and participating in the survey, because we think it's very valuable, and that's what we hear from participants as well. It really gives you the folks that like it, it gives you an understanding of what other distribution executives are thinking and feeling, both about the current quarter and about the future. So again, thank you to those who participate, and we hope you will consider for those of you that have not yet. On the next slide, this is the aggregate. This is the all-in 500-ish participants with $100 billion. So it's all of you and then some. Huge market response here. But what you see is that we continue to see gradual recovery on the left-hand side here. On the right, those are some of the subcategories. Building products, that, as we shared with you earlier, seeing good strength throughout. Safety clearly had some very idiosyncratic things going on with the pandemic, so that's sort of a separate issue. Industrial here, -6 in the fourth quarter. Not bad, not great, but much better than it was a quarter and 2 quarters ago. So generally, as the respondent here, this is a mechanical and power transmission distribution executive told us revenues are almost back to flat, and the order book is even more encouraging right now. As we look a little more granularly into the months specifically of the fourth quarter, what you see is that the trend got better even within the quarter. Month by month, those deltas continue to progress. And as this respondent told us, conditions got progressively better through the fourth quarter. December was very good, and the outlook for 2021 is also very good. And as we note here, for those folks that responded in the market commentary section, which is just sort of a free form, tell us what you think, 70% of the comments that unprompted mentioned December were positive in tone as it relates to the current quarter and the outlook. So that's encouraging. Next slide, the top 5 product categories in December. So this is specifically about December. Interestingly here, it's building products categories. And you might think that's a little odd because there's a tremendous amount of seasonality with these categories. So why are they so strong? I think one is that there were some availability issues in the prime selling season that alleviated as we got toward the end of the year. And because of the seasonality of these businesses, a small increase in sales can lead to a high percentage. So I would just point out that the building products categories we show here saw very good conditions, but I think it was partially because of those availability issues, as the comment here mentions, that unwinded as we got to the end of the year. On the industrial side, the 2 top categories would have been safety, which again have their own trends going on, but fasteners, which also says something about the growing strength of the industrial economy. Next slide. Here we break out each of these individually. So the green is the building products and the blue is industrial products. And when you look at those 2 things together, the building products, it almost feels normal. We're seeing mid-single digit growth rates. It seems like we're back to normal there. The industrial products, we're still negative, getting better progressively. And importantly, the outlook for the first quarter is that we're just about ready to crack the Mendoza line here. The first quarter forecast is basically for flat. On the industrial front in general, as the comment here says, they expect a good first quarter, but a really good second and third quarter, and things to pick up through the year. The reason for that, I think, is when you look at those year-to-year comps, most of the respondents here had very negative numbers in the second and third quarter of 2020. Therefore, as things gradually progress through 2021, that year-to-year comparison is going to be extremely high for most of the respondents. I won't spend a lot of time on the next slide here. I would just point out that the 2021 outlook, when we asked 90 days ago what folks thought about 2021, they were saying plus 1%. In the most recent survey, it's now plus 4%. So I think that implies that there's an upward bias to people's expectations. Just 2 more slides I want to go over here in terms of conclusions. One is on the industrial side and one is on the building product side. On the industrial side, I think this theme of gradual improvement I've hit home a number of times, but this specifically is cutting tools, mechanical power transmission, hoses, and fasteners. And what you see there is that those hardest hit end markets continue to recover. And as you look to 2021 as a whole, that group is thinking 4.5% growth in 2021, which means 2021 is going to be, of course, higher than 2020, but most are telling us it might still be slightly below 2019 in terms of absolute revenues. That's the aggregate. I wouldn't say that stands for everyone, but that is the aggregate response. The final takeaway here, and consistent with the theme, is that the COVID winners from last year, the roofing, pool and spa, HVAC, lumber and building materials, those categories, the building products categories, the residential related categories that did really well last year. There was a theory that maybe because they did so well last year, that there would be some sort of a fall off in 2021, or I would call it a COVID hangover. Well, respondents are telling us that's not the case. So the outlooks for 2021, when you look at the top 5 of highest growth rates, 4 of those 5 are these building products categories. So I think that's encouraging in that we most likely will not see this COVID hangover and continue to see good growth among those building products categories. And again, the red bar here, OEM fasteners, I think that tells us the industrial economy too is looking to gain steam and even start to grow into next year. Final slide I will share with you is the grid of the 18 product subcategories that we poll from all of you. And 3 real takeaways here. One is that while the heavy industrial categories remain negative in the fourth quarter, those deltas are shrinking and growth is expected in 2021. Second, we haven't spent much time talking about this, but inflation. 1.5% inflation in aggregate in the fourth quarter is actually a pretty good result. And in conversations and in commentary that we heard from folks, we're hearing about a heavy annual price increase letter season. So we've seen a lot of the OEMs sending out price increase letters, which all of you as distribution executives know better than I, that inflation is almost uniformly positive for distributors and really could be a key theme as we move into 2021. And then finally, the top growth expectations here among the pandemic beneficiaries, those building products categories, weather permitting, should continue to have a good go of it here in the next year or 2 as well. So in conclusion, what I'll leave you with is it's pretty easy to be optimistic about industrial and building products distribution end markets as we enter the new year. So that's the overriding takeaway. We're generally quite positive and optimistic about what the next year will bring. So thank you for your time today. Thank you for participating in the survey. We look forward to speaking with many of you periodically throughout the year through the survey process. If any of you would like to reach out to me directly, please feel free to do so. My contact information should be here, or you can get it from Tom or from us. So with that, I will go ahead and turn it back to Tom Gale. Thank you.
Hey, Dave, just can I ask a quick question to you on one thing that just of all these that surprised me a little bit was the Jansan being such a much bigger decline than everything else. Is that due to closures primarily that you're seeing, or I don't know if you have an opinion on that one?
Yeah, so the 2 categories that have seen the wildest swings have been safety and Jansan, of course. So I wouldn't want to read too much into one individual quarter. I mean, we've seen quarters where that's been an incredibly fast growing space. So I guess what I'd say, Ranga, is because we're talking there about things like Clorox wipes and cleaning products and things of that nature, protocols have changed quite dramatically for folks. If you're talking about the pricing there, and that may be what you're focused on, is at minus 5.2. We've seen some of that in safety. It doesn't show up as acutely here, but what we saw was initially when the pandemic hit, there was such a rush for demand for these products, and they weren't, the supply chains weren't ready for that level of demand. So there were shortages and prices were high and so forth. Over the past 6 months or so, as the supply of those products has come back to the market, some of those prices have come down pretty dramatically. So I would say those 2 things: high volatility to begin with, and second, very end market specific issues as it relates to availability, lack of it earlier in 2020, and more product available now, which can lead to some negative pricing.
Got it. Makes sense. Thanks, Dave.
Yeah,
Yep.
and thank you so much, Dave. I'd like to spend a few minutes here, and Ranga, as we have in past years, I'd like your perspective as well. But I really just want to focus on one topic and touch on a few different aspects of it, and it's really around transformation. And your comments before, Dave, really about sort of the fundamentals value proposition of distribution in terms of supply chain and that core need really, I think, forms the basis where, from our own Outlook industry surveys that we do in the fourth quarter every year, and support everything that you say here. So I just want to take a couple minutes and talk through a couple of those aspects. You know, in our survey, the impact of the pandemic and the uncertainty of that really painted out that was the top item, of course. You know, here coming into the end of January, already been a big terms of, as you mapped out, and all the macroeconomic indicators are really starting to indicate that there's going to be pretty positive trends here coming up in 2021. You know, nobody predicts the timing, but I would say that everybody's betting on the trajectory that you mapped out here. It seems like a pretty nice map. One of the key things, though, is and this comes back to taking a look at cycles in these markets. You know, if you go back, even back to the .com right at the beginning of the 2000s, and there was an impact there, then all of a sudden there was a recession, and then there was a whole rebuild and a pretty powerful growth cycle throughout the beginning of that first decade of the century. I remember back, it was 2007 or 2008, using the analogy of a Venturi effect. And it was really then that it seemed that technology was really starting to take hold and an impact for those distribution businesses that started to leverage, make some changes in terms of how they were using technology, and seeing a lot of value out of that in terms of really addressing cost to serve, as well as some more competitive aspect of what they were getting out of technology. We're going to talk about that a little bit just on these next two slides too as well. But the other point I wanted to talk is in these cycles in terms of how these markets shift, customers shift in response, and then how you see this realignment of value and what that looks like. And I think one of the key things that's taking place right now is just how quickly that this whole digital transformation really is impacting some of the core business models, and people are adjusting. And obviously the pandemic accelerated that by years, arguably, for many companies. And then the other thing is really the aspect around the consolidation cycles that you see, what takes place, and what you mapped out there in terms of M&A activity in 2020, where there was really obviously a complete pause, but just quarter the pace of the way that it's picked up. And already this year, some of the deals that have been announced, you know, this year, obviously there's going to be a lot of consolidation, but as you've seen in your career, you also see this fragmentation take place. And you know, it's almost at the same time sometimes in terms of niches and ways that specific distributors start to go after specific customer segments and needs that emerge. And it's like, in some ways, the whole Jansan thing that we were just talking about had some of that to it, in terms of, in very specific markets and customer segments, there was just this huge uptick where in some of the charts that you shared with, you know, overall there was sort of, you could see, you know, the general downturn continued there were some spikes in there. So the aspect this time too, I think, that we're starting to see is you're starting to see more digital business models, platforms, marketplaces. You know, Amazon Business was the first one, but you're starting to see, you know, this an expansion and evolution really of these marketplaces that they're starting to impact. And I mean, not to give how old I am, but I remember in the 90s when integrated supply first came in, and it was looked at as this was going to be this existential threat to distributables. And depending on what you look at there, did it take 10%, 20 out of sort of core markets that had been handled more by traditional distribution models? A lot of the estimates were in there, and it's continued to play. But what you're seeing now, I think, in some ways, is you're seeing some customer segments going back to rearranging and reconfiguring some of their sole source arrangements, some of the strength in integrated supply taking place, but also some of these e-procurement platforms starting to become more integrated as well with traditional distributors. So a lot of what we're seeing right now is going to be just playing out here in these next 12 months. And what that leads me to is just to talk about, for those of you who have followed MDM for any time, you know that we kind of use some basic pillars in terms of how we approach our research and coverage of the industry. And this really goes back 20 years to a lot of our work initially in terms of taking a look at core differentiators in distribution. And I think the key thing that I just wanted to touch on for today and talk about briefly is this whole aspect of customer experience. I talked about it in a blog this morning, actually. And where I think things have really come to is that it seems as though, and as much as I don't like to use this word, a much more holistic approach in terms of what the customer life cycle looks like and managing the customer relationship. And a lot of that has to do with, I think, in some ways, what Amazon pushed in terms of the customer centricity and their whole mantra around that. But I think we're starting to see that take hold. And in the survey that we conducted in Q4, I think had a lot of impact. We had a lot of feedback about paying closer attention and trying to get as close as the customers all throughout the pandemic. And one of the first pivots really was to immediately connect and identify how to preserve those relationships, and then more future focused, really how to transition those and what they needed to do to become more agile and serve those needs. The final slide here before we go into general Q&A, and I'm sure we have quite a bit, is to really talk about the impact of this and digital acceleration and platforms as well. And Ranga, I know you've heard some feedback in terms of sort of how distributors have been shifting the way that they've been approaching their technology and looking at it. I mean, I'd be really interested to hear your comments and what you've been hearing.
Sure, Tom. And I'd say you've got on here digital acceleration, and the big thing I would make a comment. As we talked about before, we've been doing this now together for 10 years. It's not that there was suddenly a complete shift. That we had been talking about one thing for the last 9, and then suddenly this year we're talking about something completely different. This has really just been an acceleration of everything that we've been talking about for many years. There are a few areas that I think have accelerated more than others in what I've been hearing from customers. So the first one on the platforms front, we talked to a lot of folks where they had older systems in place that were working fine, right? They weren't broken. Prior to last year, they were operating fine. Last year really put those systems through the paces, and what it really did was it really drove a adoption of people saying, things that worked okay, for a handful of folks working remotely doesn't work for having to move the entire organization remotely for a period of time. And so we saw an acceleration of replacements from that standpoint. And that's across the board, whether you're talking about kind of $1 million, $2 or $3 million distributors or, $100 million distributors. We saw a lot of focus on cloud adoption. This notion of, moving from 5 offices or 50 offices to 5,000 offices or 500 offices, depending on the size of the company, obviously. And so that was a big thing where people needed to be able to access the system from wherever. You saw that being a huge driver. And then probably the last piece on the customer experience front, just the changed expectations. People, we had talked about this for a number of years, which is, people expect to be able to sit on their couch and watching the Super Bowl and be able to order things. You just saw a lot more of that come to fruition last year, and you saw some of the trends that really were starting to happen, but you saw much more of a acceleration towards them. So things like buy online, pick up in store, or curbside pickup, or any of those types of trends. Even more so that you would think of as retail trends primarily, also happening on the distribution side. So just a lot of acceleration on that front. And then probably last, it's second bolt on here, but I saved it for the end. Is just the marketplace evolution, where marketplace is becoming a more increasing part of the strategy, to increase reach and to increase, how distributors get to market.
Along the customer experience and survey, one of the top pieces of that in terms of improving employee productivity too was automating processes. Bringing in automation was the top. Was really the top that distributors were investing in 2020, and I know in terms of order automation and other aspects, that was really a sort of at the top of the list for a lot of distributors that we would. A year ago, we talked a little bit about this rise in marketplaces and platforms, and Dave, we also talked a little bit about Grainger and Zorro, and you're very close to a lot of these public companies. What are you hearing in terms of I guess the impacts of as you continue to get some of these alternative platforms coming into place? And I mean, clearly there's a lot of investment in development work that more traditional mortar distributors are really putting into their digital assets and capabilities.
Yeah, and if I could, Tom, I'd like to just answer a couple of questions here. That one came over the chat, but the slide that shows the global PMIs, that's January 2019 through December of 2020, just so that's clear for somebody. And then Ranga, to your question, I should have mentioned the facilities maintenance, Jansan. A part of the reason that the revenues there are down also is the end market we're talking about, because a lot of that's hospitality. If you think about it, it's hotels, motels, casinos, etc. So that's the revenue side. The pricing has its own dynamic going on. But yeah, Tom, so to your question, I think the answer increasingly, and I don't mean to give you a non-answer, it just feels like there's such a spectrum from a customer standpoint of what's important to them. And you can't really be all things to all people. And I do think being efficient and having product availability and some of those things are non-negotiables. But I think in terms of the customer experience and the customer interface, whether it's a very, very high touch model, like a vending model or integrated supply or on-site type solution, versus as you mentioned, with a Zorro type of model where it's just click and buy. I need something, I want to be able to find it easily and get it delivered to me relatively inexpensively. It's just such a continuum, because I wish I could tell you that I know that this is the model that's going to work, but each of those models works really, really well for certain customers that value that value proposition. And so, yeah, we're seeing a whole range of solutions, and I think all of them are enabled by technology. That was the point I was trying to make, is that all of the functions of distribution, no matter how you go at it, is being enabled, being made easier by technology for customers. But in terms of one size fits all, and I know that's not the question you were asking, but I would say that the non-answer I'll give you is that it just seems like the more we see all of these different range of solutions that are so different from one another, but yet they can all be successful, it just says to me that customers have a completely different set of requirements and things that they deem important.
Yeah, well, actually, Dave, I think you did answer my question exactly, because the point I was trying to make when I talked about business model transformation and this aspect of both consolidation taking place and fragmentation is I think it's easy for all of us to kind of get hung up on the headlines about, either sectors or, burning up in terms of consolidation trends or, the big deals are happening. But at the same time, it really is about fragmentation and serving very specific niches that has always defined and will continue to define, even with a lot of what's taking place today. So I really think you nailed it when you talk about 12 months from now. I think we'll see a lot of types or versions and of marketplaces out there and platforms that emerge. And the other aspect of that I wanted to touch on around buying and marketing groups, because they've also gone through their own consolidation as well, and you've seen a lot of that. But still, it's very much serving specific niches with very specific types of value propositions. There's a question here. Do you think that some or many distributors really know their customers as well as they believe they do? If customers' needs were being served well, would Amazon have boomed like it has? Anybody want to take that one?
It's a really good question, Tom. This notion of do they really know them as well as they believe they do? Customer insight was a big focus area that we had a number of folks, a number of our of prospects that we talked to really trying to get to. We saw a big focus on KPIs and trying to understand where their customers were in order to make decisions. So I think the short answer is that probably not. I think that there was a realization that as they started to get that data and try to pull those KPIs in, they didn't necessarily have the data to support it, and they needed to go and figure that out. So that was some of the conversations that we had on that front.
Yeah, I mean, well, go ahead, Dave.
Well, yeah, I know I won't be able to get away without dropping this in here, but I've had a love-hate thing going on with Amazon Business, Amazon Supply, and part of me, I honestly believe that if they are 10 billion in revenues, which is the number that's out there, I don't know if it's real or not. I think there's two things going on. One, part of that was jump-started by customers that were small customers that were just buying through Amazon that switched over to Amazon Business. So I don't see a very distinct line between those two things. I think they were jump-started. Some of those sales were cannibalized within their own organization would be my guess. And the second thing is I think there's a difference in types of products we're talking about too. And I think it does speak to this knowing your customer and what's valuable to a customer. And sure, if a customer is just looking to buy a can of WD-40, that doesn't take a lot of hand-holding. It doesn't take a lot of not customer or product knowledge or supplier help. It's sort of it is what it is. I click and buy and away I go. And that's kind of, I think it falls into that spectrum thought, is that there's a lot of people that when they want that type of purchase, there it is. But if I'm a metalworking guy, or if I'm some other type of a contractor specialist, like an HVAC specialist or something, there's different needs there. And I don't think necessarily a click and buy is the way to go there, because the risk of failure is high too. You buy the wrong product, the risks are higher. So I think at the end of the day, it falls under that entire theme of, for some customers, that solution works absolutely great, and it did take share from a lot of traditional distributors. But for others, it didn't, and it probably never will unless they change.
Yep, and shame on me for asking that question with about 3 minutes left, because that's more of a one-hour webinar to address that question than it is a 3-minute question before we get to the top of the hour. And but I would just like to say, to rest assured, we're doing a lot of work right now in terms of look at how Amazon is evolving. That 10 billion figure is something that we used and that they then came out with about 2+ years ago. So as I think everybody on this call knows, they don't reveal that, and so it's a guesstimate. we will be doing quite a bit more coverage of that coming up here in the following months. We have come to the top of the hour. I do want to be respectful. We do have questions here. I will follow up with Dave and Ranga with them. And with that, I would just like to, again, thank you for joining us today. I'd like to thank Oracle NetSuite for their sponsorship and ongoing support of this. And Dave and Ranga, as always, a really interesting conversation. It'll be really interesting to see what we're talking about a year from now. With that, thank you for participating today, and this concludes our program.
Thank you so much, Tom. Thanks, Dave.
Thanks, Tom. Thanks, Ranga.
Have a great day.